Welcome to Construct Tech TV, and I'm Peggy Smedley. The construction market is the strongest it has been in years. Or is it? And perhaps more importantly, how long will we ride this current economic wave? I'm going to ask the experts throughout this entire episode. But first, let me give you my thoughts. The construction companies I've been speaking with feel very bullish about the economy. But the responses begin to actually falter just a tad when I press them about how they see the entire future. Yes, the industry is coming on strong, but there seem to be all these clouds looming on the horizon. And this kind of includes factors such as the growing worker shortage, rising interest rates, and even increasing material prices. To get a better sense of the market, let's take a look at some of the recent numbers. My first set of stats come from the Associated Builders Contractors, otherwise known as ABC. Now here's some good news. Roughly 3 in 4 construction firms expect sales will rise in the next 6 months. That means 3 in 5 companies expect higher profit margins, and 7 in 10 expect to boost staffing levels. All 3 components are well above the index threshold of 50. And that indicates confidence is on an upward swing, simply meaning things look strong today. Great, right? Well, let's hang on a minute. ABC also points out that the long-term outlook is not as crystal clear. Why? Rising interest rates, workers, and materials are becoming all more expensive. So that's just one prediction. Now let's look at another. As you all know, I like to compare and contrast all these different numbers out there. Now, CFMA's quarterly Confindex paints another interesting picture to where things are today and where actually things are headed. Now, in the third quarter, the confidence rose to 123. This is up 3.4% from the second quarter's reading of 119. And it's important to keep in mind that anything less than 100 indicates pessimism. So we're on the rise, and that's a good sign. But it's important to note that the year-end outlook index slipped to a reading of 113, which is down nearly 6% from last year's reading of 120 at the same time. This is one of the most significant year-over-year declines. Not so great. And that's where I think we need to focus some of our attention today. While the economy is good, again, you know the same factors that just might put a crimp on your future growth. So let's be clear. The goal here is not to be a naysayer. To the contrary, my hope is to prepare you. If you focus some of your energies on some of these issues that are creating the problem, such as the shortage of talent, you can determine how to leverage new emerging technologies to combat all of these challenges. The Internet of Things, AI, machine learning, for instance, are all of the emerging solutions that can help you provide you with all of the data necessary to get the job done. I think you need to begin to adopt technology to prepare you for the future. It takes time to make technology work for your operations. It's all about technology, people, and the processes. Many construction companies are feeling more bullish about the economy. But should we be watchful about some of the issues that are hovering the industry? Do we need to prepare today for what is coming in the next few years or so? Here to talk with me about the economic trends and consumer confidence is Stuart Binstock, President and CEO of the Construction Financial Management Association, otherwise known as CFMA. Stuart, welcome to the show.
Thank you, Peggy. Nice to be with you.
So, Stuart, let's talk about the current economic and building trends and what your members are telling you right now.
So, Peggy, we have a survey we issue quarterly called the Confindex, CONFINDEX. And on a quarterly basis, we ask our members a series of questions. So in the last quarter, ending at the end of September, what our members told us through the survey, there was a 3.4% increase in confidence from the last quarter. That's a fairly significant increase. When we look at the current economic conditions, the current construction conditions, financing doesn't seem to be much of a problem. All of those tend to point towards a very positive direction from the perspective of our members. My only cautionary note would be this was done in early October before the jittery market in the middle of, I believe it was October. So it doesn't reflect anything that happened in the month of October. But at that time, at that single point in time, at the end of September, our members were very upbeat.
So let's talk about why members now might be getting a little bit, on edge. We've just completed the midterms. A lot of things happening with what's going on in Congress. We have discussion about tariffs. What's making something, with your members a little bit on edge? What are they fearful about going forward versus what has been in the past? What's your take on what's kind of getting them a little bit concerned about the future?
Well, we also asked them the question, how do you view things as you look a year ahead? And when they tell us a year ahead, their responses went down 0.9%, 0.9%, so close to 1%. But from last year, it's about a 6% decline in terms of their confidence looking a year ahead. Our economist tells us we're in the 10th year of an 8-year economic cycle. And I know that makes a lot of our members nervous. This survey was done before the elections and before everyone started talking about infrastructure investment right after the elections. So I think there was some negativity there. And also maybe something we could talk a little bit about factors into this, which is the labor shortage as well. That's a constant concern to our members. And I think that might factor into their look a year ahead, trying to figure out how they're going to staff the work that they have now.
We have two things we have to talk about. You mentioned infrastructure. It's great that we have talking about infrastructure, but the fact is we're not doing enough about the infrastructure. You also mentioned the labor shortage. Well, we have a huge labor shortage. About 2.3 million is what we've been talking about, but we don't have the workers to fulfill the needs that we have. So it's a catch-22. It's great we want to talk about infrastructure, but if we don't have the workers to be able to do it, how do we address these challenges the industry's facing right now?
Well, you're absolutely right. We actually wrote the president 2 years ago when he first came on board and suggested this very problem, that we're talking about some huge infrastructure investment, but at the same time, some of his policies would have a negative effect on an already existing labor shortage. It's just all been exacerbated over the last 2 years. When we ask our members what is their top policy concern, 85% of our members tell us that labor shortage is the number one concern on their mind. 85%. It's 4 times any other issue. So it's the number one. I always like to say in real estate, it's location, location, location. In our industry, in the construction industry right now, it's labor shortage, labor shortage, labor shortage.
So when we talk about finding the talent, we're not only talking about in the office, we're talking the trades right at the job site. But the problem is we as an industry as a whole aren't doing enough to show the young talent why they should consider construction. It's almost as if we have to disrupt all the other industries and almost, you don't want to say, but actually get them from other industries to come into construction to see that construction is just as vibrant as any other industry. But we're not doing enough as an industry. Why not? Construction is a great industry to have a wonderful career. Why aren't we doing that?
You can have a great middle-class life working as a construction in the construction labor field.
It pays well. It pays well.
It pays very well. And remember, there's no debt from college, okay? If you're an apprentice, you get paid while you're working to learn your trade. So there's even that benefit as well. We have not done a great job. I wrote an article a couple of years ago in Engineering News Record, and this is really more my opinion than it is CFMA's. But my view is the union and non-union folks don't want to talk to one another when it comes to this issue. Everybody is doing something, but they're doing it in a piecemeal fashion. To me, we need to spend millions of dollars in some kind of promotional campaign that benefits the entire industry, and a rising tide lifts all boats. everybody will benefit from
That's
some
what I've been saying. Rising tides lifts all boats. And that's what we're not doing. I agree with you. And that's the problem. If you look around, we see these piecemeal efforts saying we want to get more women involved in construction because we have less than 9%. And we see all these different fractions of things doing things. But that's not going to do it unless the industry comes together and says, let's push it together. Doesn't matter. We're still going to be talking about this problem we've been talking about. Sounds
like you and I, Peggy, need to put together a some event for the entire industry, and maybe they'll listen to us, but I doubt it.
But that's one problem. But what about the infrastructure? We still have a problem about infrastructure. We have a president who says we need to invest $1 trillion in infrastructure. Do we have to have a catastrophic event before we recognize how bad the infrastructure is before we do something? I mean, I hate to say that, but is that what's got to happen?
Well, unfortunately, it seems like historically that is kind of what's happened over the last few years. And a bridge falls, and then everyone says, oh, my God, we have to do all this work on bridges. The interesting thing is that from the election, it appears that there's only one thing the Republicans and Democrats agree on, and that is increased infrastructure investment. So the time is ripe to seize this and to seize the opportunity to see if we can pass some legislation. My concern, like it's always been, is how are they going to pay for it? And that seems to be where the rubber meets the road and where, so to speak, and where we don't seem to be able to find some agreement between the parties. But I believe there has not been an increase in the taxes, highway taxes, in about 25 years, and it seems like it's time to at least look into that.
We as consumers who drive these roads need to understand that if we want safer roads for our families, we're going to have to invest. We need public-private partnerships to look into all of this because we're at a critical juncture.
Well, I agree with you, and I think most of the public sentiment, when I've seen surveys, most of the sentiment is in favor of infrastructure investment. And I think there are actually surveys I've seen that have been in favor of raising the gas tax if that would improve our roads, our bridges, and all the other infrastructure that we have.
Stuart Binstock, the President and CEO of CFMA, thank you for being with us today.
Peggy, it was a real pleasure. I hope we can do this again.
Looking forward to it. Total engineering and construction spending for the U.S. is forecast to end up around 6% by the end of 2018. Also, spending growth for 2018 is projected to be led by select non-residential and residential segments. Top performers include transportation, public safety, and conservation and development. Here to talk with me all about it is Jay Bowman, Managing Director of Research and Analytics at FMI Corporation. Jay, thanks for joining us today.
No, it's a pleasure to be with you, Peggy. Thank you.
So, Jay, let's talk about where you see FMI sees the industry overall right now in the current state. What's your thoughts?
Well, it's an interesting question. I mean, we're actually in the longest period of economic expansion in the country, actually since 1964, which is somewhat hard to believe, especially for us who are all too familiar with the Great Recession that occurred back in '08. But with this sort of period that we're currently in, FMI's view is generally we're really nearing sort of the top of the cycle at this point. And even when you look at several of the economic indicators, particularly the ones that we follow that have historically been used to predict, when will recessions occur, some of those, particularly the yield curve in particular, all of these are starting to really get into the cautionary level, which really suggests that we're probably somewhere in the neighborhood of 18 to 24 months or so from the next recession. We believe that that's probably appropriate, just given what we're seeing also just from a construction investment perspective.
So think about that. You've been saying we're seeing this amazing growth. The economy, everybody's feeling good. Construction finally is feeling good. But now you're starting to think that maybe, are we saying the bubble's going to burst, so to speak? Are we on that bubble? Or what markets specifically are you seeing that there's been some growth right now? Are there specific ones that FMI is seeing, or maybe that crash is coming in these 18, 24 months that you're talking about?
Yeah, and I think it's important also to note that the being at the top of the cycle, what we might be predicting, with a downturn within, say, roughly 2 years, our expectation is we're not looking at another 2008 by any
Thank
means.
goodness, right? We don't want
Yes,
that. Nobody
exactly.
wants that.
No, no, not at all. I mean, I don't think that we're in the same situation that we were in '08 with a lot of the things that really contributed to that. More, I think this would be more of a moderate type of correction, similar to really if you go back and look at the construction industry over the last, 50 years, it was more of a cyclical industry. And, part of what we're seeing is that, a lot of the state budgets are in surplus for the first time in a decade. So actually public infrastructure investment is actually really looking pretty good right now, at least we think for the next 2 years. When you think of the urbanization trend in the United States, you see that a lot of transportation-related investments are occurring. We're actually seeing increased investment now in water and wastewater for the first time in several years. So on the public side, it actually looks very positive. The areas that maybe we have more concern are maybe some of those areas that are starting to look overbuilt. Take multifamily, for example. But at the same time, single family is up, but I think a lot of that just really reflects, what we're seeing from just a generational transition. Millennials are reaching that sort of mid-30s now, and that's the typical age of the first-time home buyer.
So really we're looking at urbanization is making some changes, single family, multifamily, you're talking about what's happening with the millennials. But when we talk about infrastructure, will just 2 years be enough for us to do all the things we have to do? I mean, we've got an aging, horrible infrastructure. Shouldn't more than 2 years be what we need to keep that growing? I mean, that doesn't seem to me to be enough to fix all the problems we have. That should continue to be a rising growth, should it not?
No, I do believe that we will see public infrastructure spending extending beyond the 2 years. But with the balance of spending, which is primarily, the majority of it being from a construction investment standpoint on the private side, that public infrastructure spending is actually in many ways what we believe will actually kind of temper, if you will, that correction in approximately 2 years. So I would expect that we would continue to see that investment on the public infrastructure side.
Now, on the home building side, unfortunately, we've seen a lot of destruction from natural disasters. How does that play into when we talk about multifamily housing? How does those figure into all the numbers that you describe what's happening when we look at construction numbers? And people see those and they see what's happening in multifamily and single family, and we have to do all these rebuilds. How do those look at your numbers?
Exactly. So when we look at spending at a localized level, and as we all know, construction at the end of the day is a local business,
Right.
It does have major impacts where we would see that increased investment from a rebuild effort. But just from a more of a national level, that's really what we see, from that sort of downturn in multifamily overall. But there's still several markets that are very hot and will continue to be so, may not really feel much of an impact from a recession. In fact, when you look at construction spending at a metropolitan statistical area or an MSA level, 50% of construction spending forecast over the next 5 years, from what we can tell, will actually occur in approximately just 20 metropolitan markets.
Are there key ones that you say? You say there's still some hot ones. Can you give me a couple examples of what you're seeing are really hot growth ones right now?
Yeah, particularly if we see like along the, people call it the smile of the United States, but if you kind of come down across, obviously the West Coast, across Texas, even places like Phoenix, we're continuing to see activity and through the Southeast, and then really back up across the East Coast as well. It's really more of some of the secondary markets that we think might be hit a little bit harder this time around.
So, all right. So if we say in the next 2 years, we've had all this growth, the next 2 years, contractors need to be thinking about what they have to do. We're kind of talking about right now, there might be a problem with the idea that there could be some growth issue, a decline. We got this growth, we might see the bubble. What are you suggesting at FMI they need to do? Because we've got labor shortages. There's a lot of jobs opportunities, but they don't have the labor to do it. Now we might see a downturn. What do you suggest they need to do to kind of correct things and take advantage of what's happening right now?
Right. Well, there's really sort of three things that we're really seeing several of the contractors that we're working with that are really putting into place now to be ready for that. But we think about really what do we need to do, for example, to bring more women into the construction industry. And we've done somewhat of a good job, but really the percentage of women participating in construction really hasn't changed much since the 1980s. But we do see others where they're really trying to figure out new ways to bring other people in. The second thing that we see people really doing in many cases is where can we bring technology in to augment the way in which we might be doing construction, whether that's using things like these robotic bricklaying machines to really just the use of data like software technology to help. And then the third area that we see people really trying to prepare, which is probably perhaps even one of the most important, is if you consider, as I mentioned earlier, the expansion period that we've been in, which is a really long time, there's a large, significant population of the labor force that frankly has never seen a recession in construction, as hard as it may seem to believe. And so in many cases, it's actually preparing those young people, teaching them the business acumen and leadership skills to be prepared, for those lessons learned in the next recession.
Well, I have to tell you raised some really great points. So Jay Bowman, Managing Director of Research and Analytics at FMI Corp, thank you so much for joining us today.
Thank you, Peggy. It was a pleasure.
Builder confidence in the market is holding its own right now, but is it sustainable, and for how long? Perhaps a better question is, how long should builders and contractors, all of you, ride this confidence train? We have all seen how quickly these positive upticks can turn south. Here to talk with me about it today is Connor Lokar, Program Economist at ITR Economics. Connor, welcome to the show.
Thank you for having me. I'm happy to be here.
So Connor, let's talk about the state of the industry, more specifically construction, and what you think is happening right now.
Well, construction in general is thriving, though there is some nuance within that answer as far as areas of construction that's doing well. But in general, construction and the economy itself is doing excellent right now. Most of the GCs I've talked to, their backlog's already through 2019 at this point, and they're feeling really good, and they just can't keep up, quite frankly.
So let's talk about the relationship, I think, between the general economy and construction. Are there some real connections between the two? Because we're talking about a boom in the economy. Construction seems to be really strong. Are we riding a bubble that's ready to burst? I mean, there's a lot of people saying we've got the next 24 months, 2 years, and then construction better watch out. Hopefully it's not going to be something like we saw back in 2008. Nobody wants that. But what do you see?
So we do see a shift coming now. When you think of construction or your industry, you tend to think that, well, I must be doing what the economy is doing. If the economy is rising, I should be rising with it. And in some cases that is true, but in some cases there is a timing difference. And what I mean by that is if the economy's up today, that might benefit your business tomorrow or next month or next year. You could be lagging behind the economy, which is exactly what we see with construction. Now, anyone tuning in that's tied to residential construction, you're actually on the flip side of that. You're actually moving out in front of the U.S. economy. So typically we look at residential construction, housing starts, as far as single family builds in particular, as a leading sector. We look at that as a bellwether of what is to come for the U.S. economy. Likewise, general construction, whether it be offices, institutional construction, manufacturing facilities, warehouses, anything on the commercial side of the equation, that tends to lag behind the U.S. economy, where we see building there actually reacts to the economic prosperity or lack thereof of today. And we tend to see that sector move about a year behind the U.S. economy. So the U.S. economy is doing great right now, which tells us the next year looks really strong for GCs on the commercial side of things. But we're already starting to see some slower growth taking hold on the residential side of things, on new residential single-family construction that we expect to get worse as we move into 2019. So it's kind of depends on where you're at.
Why is that? What's your take on why residential is starting to already see a turn?
Well, residential tends to move out in front. It's more directly tied to the consumer and personal consumer decision making. Also, they're just shorter projects, so they're a bit more nimble. A typical housing starts measured its progress in weeks and a few short months, where you could look at a several 100,000 square foot manufacturing facility that's measured in months and years. The same thing for apartment high rises or an office high rise. These are such long projects, they have such long lead times, they're a bit more lethargic in their reaction to what's happening to the economy today. That tends to filter through months down the line as far as new construction is concerned.
Are we seeing a change in the type of buying decisions based on the younger generation, millennials versus the baby boomers, and what they want, changing in the type of housing environment that they want to live in?
So for a number of years, really coming out of the disaster that was 2008, 2009, even starting in 2006, 7 for single-family housing construction, we saw apartment construction has thrived over the last 7, 8 years, really coming out of the Great Recession due to mangled credit, lack of ability, willingness, or financial capability. A lot of particularly younger folks like myself moved away from single-family home ownership, that more traditional home ownership, and towards apartments. And anyone building apartments, whether it be a duplex or a several hundred unit apartment complex, they benefited from that over the last 7 to 8 years. But we're starting to see that turn somewhat, where we're seeing some saturation on the apartment side of things. Vacancy rates are up. Asking rent growth is starting to cool off, and we're starting to see what we do what we typically do, which is when there's demand there, we rush to meet it on the building side, and we typically meet too much of it, and we overbuilt that demand curve on the apartment side of things, where I see that pendulum swinging back somewhat towards single-family ownership as we look forward over the next few years here, particularly amongst that younger generation, where getting out from underneath student loan debt, starting to build our own cash reserves for a down payment, getting higher incomes. The youngest millennials are, I think, depending on who you talk to, they're 21, 22 right now, so they're entering the workforce. The oldest millennials are actually getting close to 40 years old, believe it or not. So their income's starting to creep up. So we're starting to see that millennial buying pool is going to really start to dictate terms in housing as we move forward over the next few years.
So with that in mind, what is it that the construction industry needs to be doing and thinking about as we see this shift in buying power, shift in needs, and from both residential and commercial in the next 12 to 24, 36 months, in those next 3 years?
Well, so in the near term, on the residential side of things, particularly if you're building single-family homes, we're definitely seeing some warning signals there. And I always have to qualify this, because this is not housing crisis 2.0. This is not a decade ago, thankfully.
And that's number one. Well, we need to tell the building industry this is not something to push a panic button on. This is not what we saw in 2008.
Yeah, this is just prudent caution, really. We're looking for a speed bump, a mild slowdown. We're going to see some negativity in some markets, modestly so, more reminiscent to the early 2000s. I don't know if builders can remember back that far. We actually did see a slight pause in national residential construction in the early 2000s in conjunction with the dot-com bubble in that early 2000s recession, but it is not going to be anything like the disaster that was a decade ago. On the commercial side of things, you need to be pedal to the metal right now. You need to be aggressive over the next 12 to 15 months. You need to, and can be comfortable in your bids, being a bit more aggressive, trying to protect your margins and coming in a little bit higher, where the slowdown of next year in the macro economy is really not going to affect you as far as projects coming up for bid until we look into 2020, at which point any GCs out there, you're going to want to become, again, focus less so on margin, more just in your bids, just trying to secure the projects, keep the gears turning, keep the work, and really extend your backlog through 2020 into that point before we're back into that next rising cycle. So if you're on the commercial side, 2020 is where your risk lies. Otherwise, you should be feeling pretty confident over the next 12 to 15 months.
Connor Lokar, program economist from ITR Economics, thank you for joining us today.
You're very welcome. Thank you for having me.
The general takeaway today is that the current market is strong. But there are a few factors on the horizon to keep a close eye on. So I'd like to leave you today with 3 practical ways to best prepare for the future. First, fine-tune your existing technologies and processes. This can include everything from ERP systems in the office to apps your field crew are using out in the construction job site. So what's working? What's not? Ask the people using the systems today so you can work in a way that's most efficient in the months ahead. Perhaps this means looking at lean processes. You need to think about the people and the processes. It's not about breaking new ground without the people to support it. You need methods to streamline efficiencies. Next, identify leading-edge solutions that work for you. The technologies have to work for you and all your workers. The right predictive tools can do just that. That's why we have been focusing so much of our time on artificial intelligence, the Internet of Things, and everything else on all of these episodes. Smart systems can help take the guesswork out of construction. Now let me give you one example. An elevator on a construction project. So how much time is wasted waiting for a lift? Artificial intelligence actually can help. In fact, it already is. Brookfield Properties is currently monitoring how often the elevator stops on certain floors on its Manhattan West project in New York City. Now this is pretty cool. Workers don't have to wait as long to go from one floor to the next. Estimates are that it is saving between 10 to 20% of the wait time. Now think about this. Is there somewhere on your projects you can save between 10 and 20%? I'm betting there is. Emerging technology can help. And machine learning, deep learning, Internet of Things, any of these things can actually help. Now finally, create an action plan. We never think about plans anymore, simply because technology changes exponentially. It doesn't mean you don't need a strategy. To the contrary, once you've determined how to streamline processes and where new technologies can help, it's time to go to work. Create a plan for how to solve your business challenges. I will tell you, I've been covering this space for more than 20 years, and time again, it is the companies that are the most formative that are able to weather all of the downturns. Construction is one of the most resilient industries, and I believe technology initiatives have something to do with how our industry continues to thrive. Put one in place today. Innovative solutions are your best friend. Emerging tech will help you prepare for what is coming tomorrow. Thanks for watching Construct Tech TV, your fierce advocates for construction.